Back in the 1920s, Big Bill Haywood, who founded the first industrial union in the United States, looked at the gold mining industry and asked a very simple question. Why were the men and women doing the grueling, physical work to find, mine, and mill the gold, making almost nothing? Meanwhile, the so-called gold barons were making an absolute fortune. They didn't dig, they didn't mill, they just owned the capital, buying and selling the gold on the open market. Haywood called it a weird alchemy. The people taking the wealth were profiting entirely off the backs of the people actually making it. And that weird alchemy didn't just disappear when the gold rush ended. It actively accelerated into our modern era. Over the last few decades, our society has completely lost the ability to tell the difference between the actual creation of wealth and the mere extraction of it. Take a look at the British retail chain BHS. In the year 2015, the billionaire Sir Philip Green sold the business for £1 to a group of investors. But while he controlled the company, Green and his family pulled out an estimated £580 million in dividends, rent, and interest. The company collapsed shortly after, throwing 11,000 people out of work and leaving their pension fund with a massive deficit. To Green, this was wealth creation. To the workers, it was systematic plunder. Or look at Apple. The company sits on mountains of cash in offshore tax havens, using complex accounting networks spanning from Ireland to Nevada to avoid paying taxes back into the very societies that funded the foundational technologies inside the iPhone. When you look at the macroeconomic data, the toll of these practices becomes obvious. Between 1975 and 2015, productivity in the U.S. economy grew by more than 60%, yet the real hourly wages for the vast majority of workers completely stagnated. We have a system that blindly labels corporate extractors as innovators and wealth creators. By accepting that label, we have stood by while a tiny elite captures almost all the gains of an expanding collective economy. To understand how we got here, we have to look at a concept economists call the production boundary. For centuries, this was a theoretical fence used to divide all economic activities into two specific categories. On the inside of the fence were the productive activities. This was where humans, physical resources, and new ideas interacted to produce actual new goods and services. On the outside were the unproductive activities. This included things like rent-seeking, where individuals tried to generate income simply by moving existing resources around and overcharging for them, without producing anything new. This boundary mapped the rules of society. It dictated exactly who deserved the financial rewards of a functioning economy and who was simply facilitating trade. Up until the 1960s, the financial sector was kept firmly outside that boundary. Economists viewed banking as a necessary service for transferring existing wealth, not something that created new wealth. Then, in the 1970s, the rules were rewritten. The financial sector was deregulated, and the national accounts used to calculate GDP were updated to include banking. The fence was physically uprooted and expanded, pulling finance into the productive side. This happened because mainstream economics abandoned the idea that value is determined by objective conditions, like labor or the time needed to produce something. Instead, they decided that if a service fetches a price on the market, it automatically has value. Price determines value. Under this logic, if an activity earns a high price legally, it's mathematically categorized as wealth creation, even if the behavior is purely extractive. You can see this logic operating across the modern economy. Pharmaceutical companies use what they call value-based pricing to justify charging nearly $100,000 for life-saving medication. They set the price based on what the disease costs society if left untreated, completely ignoring the actual cost of developing and producing the drug. Tech monopolies exploit the patent system similarly. They use patents not to incentivize research, but to lock away innovations and extract monopoly rents from competitors. And corporate managers regularly use cash reserves to buy back their own company's shares. Instead of reinvesting profits into long-term research or worker wages, they artificially boost the stock price, which conveniently inflates their own executive compensation packages. We wrap these strategies up in complex business jargon, but don't be fooled. This is exactly the same alchemy Big Bill Haywood saw in the gold mines, updated and optimized for the digital age. When we let price dictate value, we fall into a trap. We automatically assume that any high income is an earned income. This insulates billionaires from systemic critique because the logic of the market says their wealth is absolute proof of their economic contribution. At the same time, this narrative aggressively degrades the public sector. Government is constantly framed as an inefficient, plodding tortoise, draining society through taxes, ignoring the fact that public funding pioneered almost all the core technology in our smartphones and computers. By accepting this illusion, we systematically starve the real economy of patient, long-term investment. We reward the takers at the expense of the makers, directly fueling the severe political and social inequality fracturing our societies today. This is why merely taxing the rich after the fact isn't enough to fix the imbalance. We have to dismantle the underlying story that they are the sole creators of our wealth. We need a revival of the debate over what actually constitutes economic value. We have to look closely at our production systems and actively redefine the boundary between making and taking. Because if we fail to accurately define what creates wealth, we won't know how to sustain it, and we will continue to surrender the global economy to the takers.